Hello and welcome to another edition of Real Talk, where there's a lot to report at the moment. Last week I reported that if you had a home loan and you wanted to fix it for 2 years, the rate was 3.99%. A week ago, to fix it for 3 years was 3.88%. This morning the rate went up to, for 3 years, it's gone up to 4.1%. Now, I'm not going to make any great predictions, but this is the first telltale sign that the institutions believe that the rates are actually going to be higher in 3 years' time. So I just want to say to everybody, if you have a home loan, take advantage of this time now. Be paying off as much as you possibly can. Money will probably never be this cheap again, or certainly it's not going to be this cheap for much longer. So take advantage of it. Interestingly enough, the clearance rate, we had 730 homes approximately on the weekend go to auction, and 68.9%. So we're still hovering around the 70%. So my predictions in that sense are that the market will continue strong in the home owner market. First home buyers are still down. We talk about rent vesting. People are actually renting where they want to live and buying where they can afford as investment properties. I think the biggest change for Australians is that we have a real immaturity about our maturity. We have for so long thought that the great Australian dream is to own your own home, and everybody had access to that. Unfortunately, that is changing. At the same time, so too are the dynamics. People aren't wanting to rent together anymore. They're living, more people are living on their own for longer. The days of shared accommodation are really gone. Amenity, proximity, and having transport, public transport, are the strong key indicators. So I really think that market will continue quite strong in the homeowner. First home buyers are having to reinvent themselves, and as I've said to a lot of people for a long time, we have to be investing to help our children buy property as well. Interestingly enough, a lot of studies are telling us now that the generation, like my generation, that are investing now, it certainly helps the second generation, but the ones that really benefit are the third generation. So if you're investing today, it's your grandchildren that are going to get the absolute uptake from that. On to other markets. The commodity markets are on a slight improve, which is really great for all of our producers. We've got the stock market is down 1% at the moment, but the banks are still slightly up from their positive reporting. Mining is down, except of course Fortescue, who came in and carved their expenses to the bone. They've actually reduced their operating costs by 50%, so their share price is up 10% at the moment. So it's good to see companies, Australian companies, reinventing themselves to meet the market, which is absolutely brilliant. In terms of the overseas market, the US has come out with a much stronger reporting. Now that they've had a couple of successive strong reporting periods, they were wanting to increase interest rates at the start of the year. They held off on that. The word from the analysts now is they will definitely go for an increase in rate in December. China's up, which is really great. Of course, all of the languishing economies in the European Union are very quiet at the moment. So I think internationally we can see a real change of a lot of policies that are being implemented are actually coming to fruition now. And on the local market here, of course, the investor market is under fire with a lot of Asians exiting. My predictions are that the English market will grow, and we're seeing some amazingly strong reporting coming out of the UK at the moment. I think I was quite scathing about some of the very negative reports about the Brexit. Of course, everyone's an expert at the time, and all the doom and gloom, but the reports are amazing. They're actually really gaining momentum. Their property market's doing well. Their economy is actually showing signs of real recovery. So, once again, we move on from all of these things. Now, in closing my report, last time I did my Real Talk, I benchmarked I benchmarked South Yarra with Brunswick. This week I'm going to talk to you about the difference between Fitzroy and St Kilda. Now, for those of you who know I live in St Kilda, I love St Kilda. Medium house price in St Kilda at the moment, and bear in mind East St Kilda and St Kilda proper are quite different in terms of Nepean Highway dividing them, but currently medium house price is $1 million in St Kilda. Medium house price in Fitzroy is 1.360. So if you look at the two suburbs, you'd think that they would be quite comparable, and with the beach in St Kilda and the amenity, the proximity, but it's actually Fitzroy that's really overperforming. If you look at medium unit price in St Kilda, 590,000. Medium unit price in Fitzroy at the moment is 650 to 680. So it got me to thinking, and I did a bit of research years ago. In fact, in 1956, there was a report in the papers in Melbourne saying that Fitzroy was going to be the #1 suburb in Melbourne. Now, it had a lot of crime, it had a lot of issues, and of course, modern day graffiti has been a real issue. But isn't it interesting that it's actually having its shining now? You know, 60 years later, 70 years later, it's actually really shining. So our demographics are changing, the way we finance things are changing, the way we feel about property is changing, and I really think that it's a time for us to step into the next demographic and understand where we're really heading on the real estate front. And just remember, when you're investing today, you're investing for your grandchildren. I'll leave on that note. Thank you.